What other roles does the share market have? So one of the main roles is, of course, to bring finance in initially for the companies, if you have the primary market, if you have issuing of new equity. But then the day-to-day business is basically trading of existing shares. And why is that important? Well, just imagine if you have a lot of shares at home, you've got your money invested in shares, and then you set your car against a tree. What might you want to do? So you need a new car. Let's presume it's not fully insured. You need cash for it, so you want to sell your shares. And that works much better if you have a well-functioning share market. Just imagine how hard it would be to sell a private stake in a private small company to find somebody quick. That would be very hard. If you have a well-working stock market and you have shares in large companies that are publicly traded, you just call the banker or you go on your online banking account, sell the shares, get the money 2 days later, done. So it's one reason, liquidity we call this one in finance, so how quickly something can be transferred into cash. But it also provides market discipline. Now what does that mean? Basically for the managers of large companies are also employees, they're not the owners of the company. And they might have an incentive to go a bit slack. I mean, they earn lots of money, they often get these golden handshakes. If they don't do a good job, they get fired, but they still get a large payment afterwards anyway, right? So there might be a little bit of an incentive, maybe not to work that hard or not to do the best thing for the company. That's the reason why managers often also get shares in the company. And now you can imagine if the share price drops, the manager directly suffers. But also, the share price fluctuation is kind of representing all the information that everybody else in the market has about the company. So if lots of people believe the company is not doing well, the manager is not doing well, they start selling the shares and the share price starts coming down. And since the managers are also only employees, they might get fired if the share price is dropping too much. So they look out on the share price and they always want to usually maximize the share price. They worry if the share price is dropping, especially if the share price is dropping of their company by more than of other companies in a similar business line. Right? Of course, if the oil price is dropping, oil companies don't do that well. But if the oil price is dropping and your oil company is doing worse than all the other oil companies, then you might get into trouble. And the share price giving, I don't want to say reliable information, but at least very fast information all the time. So that's what's meant by market discipline. What else do we have here? If you're trading in shares, we can buy and sell, and we can also do it either at market or with limits. So you don't have to say, I want to buy the share at any price. So you can put an upper limit, just as on any auction on eBay, where you put an upper limit on what you're willing to pay, or minimum reserve price on what at least you want to get if you sell something. You can do the same with shares. So this is a printout. In this case here it's ComSec limit order book from Commonwealth Bank, CBA, I think that's Commonwealth Bank, shares. We've got bid, offer. So one is at which price people want to buy shares, and the other one is at which price people want to sell shares. How can we figure out which one is the buying one and which one is the selling one? But just imagine, let's say if this one is the one that they wish to sell for, and this one is the one they wish to buy for. Is that an equilibrium? No. Then immediately deals would go through and the price would start changing. So that can't be. It must be that these two don't 100% match up yet. So people want to sell their shares at this price, but buyers want to pay only this price. So that means between that one, the market now is stuck. So these two don't match up yet. And the ones that match are already done. They're already out of the market. The deals that have already been done. Order book is basically this thing here. It's how we write down information, how many buyers, how many sellers, and we give them a ranking too. So buyers, the ones that are willing to pay the highest price, come on top. The ones that are willing to pay less, well, they go to the back of the line. Because the one that is willing to pay most is, of course, the first in line. Similar with the seller. So which seller is first in line? The one that sells at the cheapest price or the highest price? Cheapest. So the cheapest one is first in line. So we're matching the cheapest seller with the buyer putting in the highest bid. Now these two don't match. That's the reason why it's still written on the book. The trade didn't happen. And you can see they're fairly close already. And then we've got the volume here. That's how many shares these people want to buy. Here too, how many shares they want to sell. What else do we have here? High and low. So these must be the highest and lowest bids. Volume, how much trades had happened already in number of shares. Trades in number of transactions. And value is how much dollars altogether have changed hands in this sense. And open is the first quote of the day. Or the first, I shouldn't say quote, first trade of that day. So the first trade that was made where buyer and seller matched was at this price. So prices change every second basically. We've got a tiny little exercise. So if you want to buy, or anybody wants to buy 1,000 CBA shares at market, so they kind of don't care at which price. The question is, at which price will they get them? 1,000 shares. So we have to go back here and check. So we want to buy. At which kind of price can we buy 1,000 shares? At this price, people want to buy shares. But if you want to buy something, who do you have to talk to? To other buyers or to sellers? To sellers, right? So you have to look as a buyer. I know it says buyer here, but you as a buyer have to look really at these prices. So the cheapest one you can get your share from another seller is 7,700. Is he willing to sell 1,000 shares? Yes, right? He's even willing to sell 5,000 shares, so that will work out. Right? Very good. And again, I want to emphasize, it's perfectly fine to make little errors here in class, even big errors in class. It's not okay to do them in the exam or later in your job interviews. I would say that is the last trade that happened. The last trade was possibly at that price, so we can see this one here. The reason why I'm 99.999% sure that this, you can't get it at a price, because there is no seller. There's no single person in that economy that is willing to give you shares at that price. There was obviously one 2 seconds ago. That's the trade that we can see here. That's the reason why we saw the last price here. So just imagine eBay. I think that might be easier to understand. So if you look at eBay at the sell history, at past auction prices, you might have seen something had been sold in the past for, let's say, $300. And now you look at running auctions, and the cheapest buy now price is $330 now. Just because yesterday something got sold for $300 doesn't mean that you can get that now for $300. The cheapest seller that you see on eBay now is $330. And if you say, I want the thing for sure anyway, all you can do is click buy now, and then you get $330. And by the way, you can make a learning exercise out of that one. So once you click buy now, once the share deal is going through, what's happening to this number? Increases, exactly, right? So it goes to the latest number that would go up to then to 7,700. So there's lots of numbers on these things. Very easy to mix things up, right? Especially the buyer and seller thing. I always have to take a bit of a breath too, that I don't mix it up myself. Like, it's logical, and if you think about it, very easy. But if you go too quick about it, very easy also to mix up and lose points for this. So do one more practice. What is this one? At a market, sell. So now we want to sell shares. So we have to find a buyer. So which price do we look at? This one is a little bit trickier because we want to sell 3,000 shares. If you start selling shares, at which price do we start selling them? $73.69. Thank you very much. So that's very good. We can start selling shares at that price. Look at this one. How much are available at that price? Exactly, right? So we can only sell this many shares at that price. So we want to still sell over 1,000 shares we've got spare. At which price do we have to sell those? 73.68 cents. So we sell the leftover shares at this price. And luckily he's got enough that he wants to buy. So then we are done with it. Good, what else do we have? Share price indices, if you want to look at them. So we've got a very famous one, Dow Jones Industrial, All Ordinaries, FTSE, DAX. So that is basically kind of an average share price of the largest 50 or 100 or 30 companies, depends upon what index you're looking at. And it gives us a good feeling how the market overall is performing. That's the one that is always in the news. And I've got few slides on the one a bit later. In the book they show you also how it's calculated with the weighted averages, and don't worry that much detail in this class. But there's one thing I want to emphasize for you, because you might want to invest in the share market yourself, and I will give you readings that are kind of showing that investing in index funds is in general a better idea than investing in single shares. But there's one thing to really watch out for, because we've got two kinds of index funds. The ones in the news are usually price indices. So that means we see how the share price is going, up and down, but it doesn't tell us anything about dividends. So if a company is paying out dividends, let's say a share price is $1,000 right now, and they're paying out dividends, everybody was anticipating that they will pay out dividends tomorrow, $100. What's happening to their share price tomorrow? Might go up because they pay dividends, but it also might go down because they just paid dividends. So if you own the share right now, it's worth $1,000 and you know you get dividends. Once the dividends are paid out, the new owner, the next one that buys the share tomorrow, will he get the $100 dividends? No. So he gets the share, but he doesn't get the $100 dividends. That means for him it's worth now only 900, not 1,000 anymore. So after companies pay out dividends, the share price might drop a little bit. Over time usually it's going up, so it's going up, 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 little drop dividends. Up, 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 little drop dividends. But if you're looking at the price index, we don't see all these dividends. And now imagine if you're saving your lifetime savings investment for your pension in a price index, you're actually not getting the full benefit of being a share investor because you're missing out on all the dividends. That's the reason if you're investing, you should always invest in an accumulating index so that you're getting your dividends too. Or there are some India funds that are price indices, but they actually do pay you dividends too. Right? So you want to make sure, you need to read the fine print. That's all in the fine print of financial contracts. Right? You want to make sure that you either grow with the dividends because it's accumulating, or that you get the dividends paid out. But you don't want to miss out on that because you can see what a huge difference that makes here over time. So we can raise equity privately, so that's outside of the share market. That's mainly for small firms. That's all the stuff that you hear initially with, what do we have? When Facebook was small, Apple was small. For Dropbox currently, they're not public yet. So all these companies started out private. And you can buy a share, but not on the stock market. You can buy as an private, large-scale investor, a part of the company. But sooner or later, if they grow large enough, they go public. And that means that for the first time, they sell shares in the market, in an IPO. Then they can still grow their equity by just retaining all their profits. That increases equity in the company. Or we can increase equity in the company by selling additional shares with a rights issue. Then we did a little bit of math, so we talked about how can we calculate share prices, and we can do that with a price-earnings ratio and the golden growth model. For the golden growth model, we also need the required rate of return, and we did that via the CAPM formula, which you will have in the formula sheet.